Are you a student loan? Because I'd like to have you around for the rest of my life. College graduates are now finding it more difficult to purchase a home due to student loans, and legislators are now debating solutions. 81% of borrowers claim that their student loan debt forced them to postpone one or more significant life events. Your long-term financial stability depends on creating a plan to handle your student loans. So, let's look at how to survive and thrive after student loan debt. Calculate your total debt and know the terms. The first thing you should know about debt is how much you owe. Students typically leave school with several debts, possibly both nationally and privately supported, having secured additional funding each year they attended. You cannot create a strategy to reduce your debt, consolidate it, or apply for a granted debt forgiveness without first understanding the total amount of your debt. Learn the terms of each loan as you calculate the total of your debt. Each could have a unique interest rate and payback schedule. You'll require this information to create a repayment strategy that prevents further interest, charges, and penalties. Review the grace periods and consider consolidation. You'll discover that each loan has a grace period as you combine the details. Upon graduation, you have this time before you begin making loan repayments. Depending on the type of loan you have, different grace periods might apply. For instance, Perkins loans give you 9 months before you must begin making payments, whereas Stafford loans have a 6-month grace period. When you have all the information, consider combining all of your loans. The main benefit of consolidation is that it frequently lightens the load of your monthly obligations. Before you agree to consolidation loan, make sure to compare loan terms. Before consolidating, there is another important consideration. Consolidation revokes your eligibility for several federal loan deferment choices and income-based repayment programs. Use the debt avalanche strategy or pay down principle. The debts with the highest interest rate should always be paid off first, as with any debt repayment plan. One typical strategy is budgeting a specific amount above the needed monthly repayments and allocating the extra money to the loan with the highest interest rate. Once that loan is complete, apply the total monthly payment on that loan, which includes the regular payment and any excess, to the loan with the second highest interest rate, then the third highest, and so on until you're debt-free. This is a variation of the debt avalanche strategy. Paying more principal whenever you can is another popular debt reduction method. Less principal results in smaller interest payment because interest depends on the principal each month. Explore alternative plans. If you agree to set up your monthly payments to be automatically deducted from your checking account, some private and government student loan lenders will reduce the interest rate. For instance, the Federal Direct Loan Program offers a 0.25% discount to participants. You can also arrange an alternate repayment plan with your loan servicer over the phone. If you have a federal student loan, some possibilities include graduate repayment. During the loan's 10-year term, your monthly payments will increase every 2 years under graduated repayment. Early payments under this agreement can be modest to accommodate entry-level incomes. In addition, it implies that you'll gain promotions or change positions with higher compensation as the decade progresses. Extended repayment. By spreading out your loan over a longer time, say 25 years instead of 10 years, you'll be able to make smaller monthly payments. Income contingent repayment. For up to 25 years, payments will be based on your AGI, but at a maximum of 20% of your income. Any remaining balance on your debt will be waived after 25 years. Pay as you earn. If you demonstrate financial difficulty, this limits monthly payments to 10% of your monthly salary for up to 20 years. The requirements can be stringent, but once you've met them, you can keep paying into the plan even if your circumstances have improved. Furthermore, none of these choices can be used for private student loans. Defer payments. You can request a payment delay from your student loan lender if you still need a job. The federal government may not charge you interest during the authorized deferment term if you have a federal student loan and are eligible for deferment. Asking your lender for forbearance, which enables you to temporarily stop making loan payments for a specified period of time, is an option if you're not eligible for deferral. Any interest due during the forbearance period will be added to the loan's principal. Explore loan forgiveness. You could be eligible to request student loan discharge or a debt forgiveness in some exceptional cases. If your school closed before you could complete your degree, you were rendered totally and permanently incapacitated, or repaying the debt would force you into bankruptcy, you might be eligible. If you've been employed as a teacher or in another public service occupation, you have another less dramatic but more precise option for student loan forgiveness. Although any student loan could be forgiven, student loan forgiveness typically only applies to loans issued or backed by the United States government. In other words, even if the loans are designated for students, the well-recognized forgiveness programs do not apply to privately issued loans, such as those from financial companies or lenders like Sallie Mae. Long-standing worries about the rising cost of student debt were heightened by the widely reported failure of several for-profit universities and the pandemic-caused economic catastrophe of 2020. Widespread loan forgiveness for all borrowers, not only those who work in a public service, take part in a repayment plan, or have experienced college fraud, has emerged as a hotly contested political topic. Many borrowers would love to be free of their student debt, but only some get the chance to do so due to tight eligibility requirements in place right now. Although the majority only grant forgiveness to people who work in specific public service positions. Teachers, government workers, some non-profit personnel, service members in the armed forces, and AmeriCorps members are among them. There are various types of student loan forgiveness programs, particularly for those who work in public service positions for either the government or non-profit organization. The Public Service Loan Forgiveness Program was created. In addition, if you perform certain voluntary tasks, serve in the military, or practice medicine, you could get all or a portion of your loan forgiven. Under the Public Service Program, you must first make 120 qualifying payments, which entail paying the minimum amount due on the due date. These employments must be made when employed by an eligible employer, typically a government agency at the federal, state, or local level, or a non-profit with tax-exempt status. After 10 years of employment and 10 years of regular payments, you effectively qualify. Jobs in nursing, politics, the police, fire departments, and social work are all potentially eligible. Despite their comparable outcomes, student loan forgiveness and student loan discharge are quite different. When you land a job with the government or a non-profit organization, you may be eligible for loan forgiveness, commonly known as a cancellation. Loan discharge frequently happens when the borrower files for bankruptcy, passes away, or suffers a permanent disability. What takes place if student loans are not repaid? Your credit score will improve greatly if you pay off your student debts. That's the equivalent to missing payments on any other loan. Your debt will be regarded as being overdue, turned over to a collection agency, reported to credit bureaus, and have a negative effect on your credit score. In the future, borrowing money will be more difficult, making it difficult to obtain a car loan or even a mortgage. The government can seize your earnings and withhold tax returns if you don't pay off your federal student loans. Some of these suggestions might not work for you, yet if you need help making student loan payments, there's only one awful choice: doing nothing and crossing your fingers. Your creditworthiness will improve even though your financial situation won't. But that is all for today. Remember to check out our channel for more similar videos. Make sure to like and subscribe to our channel and turn on the post notifications so that you won't miss out on any more content. Thank you for joining us, and we'll see you next time.